Top 4 reasons why chasing the gold price is an investing mistake. Why are Americans often called bubble chasers? They wait until prices have already surged, read headlines about new all-time highs, feel that unmistakable pull of missing out, and then finally jump in right before the asset tops, the price stabilizes, or it makes a major correction. Most of the time, Americans are great bargain finders and are always on the lookout for the next best profitable deal. Sadly, with investing, when finding a bargain matters the most, many uneducated investors buy at the top and panic sell at the bottom. Reason 1 of why chasing the gold price is an investment mistake. Gold should not be treated as a risk asset. This pattern repeats itself with remarkable consistency across market cycles. Gold investing should be one of the most straightforward components of a diversified portfolio. Gold provides stability, acts as insurance against currency devaluation, and offers a hedge during periods of genuine uncertainty. When investors start treating it like a momentum play or a get-rich-quick scheme, they transform what should be a stabilizing force into a source of unnecessary volatility and disappointment. The basic problem with chasing gold prices comes from the timing and the psychology that drives late-stage buying decisions. The obsession with timing entries and exits, predicting price spikes, and trading around market sentiment has led countless people to miss the actual point of owning this metal. The question, when should I buy gold, fundamentally misunderstands what gold actually does in your financial life. The recent prevailing narrative treats gold like a momentum stock or cryptocurrency, something you jump in and out of based on technical charts and analyst predictions. Gold serves a completely different function than growth assets, and trying to trade it like one represents a basic category error that costs investors real money and genuine protection when they need it most. Reason 2, making portfolio diversification a priority, not price. If your wheelhouse as an investor is in stocks and risk assets, you may need some guidance with gold investing. Gold is often seen as a boring investment. Of course it is. It's not supposed to be exciting. Insurance is bought to protect the sports car. It's not meant to be as exciting as driving the sports car itself. And you wouldn't drive that lovely sports car down a crowded highway without insurance, would you? But to that point, the steady rise in the gold price in the last 3 years has provided some excitement for those who bought at the right time. They didn't buy when gold was rocketing up in price. They bought gold because it was time to buy insurance and prepare for any-time risk. Yes, bonds do provide some hedging protection, but bonds are not a hard asset like precious metals, real estate, fine art, or the like. Bonds also suffer from a similar drawback that stocks suffer from: counterparty risk, that party being the federal government. If we were living in a steady environment of fiscal responsibility, national debt solvency, zero inflation, and balanced budgets, then government bonds would probably be the only portfolio hedging asset you would need. But we do not live in this world and do not appear to be entering it at any point soon. Regardless of the political party or administration in power, both sides appear to have a steady record and an insatiable appetite for overspending. Therefore, owning an asset that a counterparty cannot manipulate the supply and value of is of paramount importance. A common objection to gold and silver ownership is the opportunity cost of potential gains in the aforementioned risk assets. The answer to this are gold and silver leases. Gold and silver leases provide investors with the opportunity to gain a competitive interest rate that matches or exceeds the yield on bonds. Monetary Metals is a gold investment company that delivers a real interest yield on gold, paid in actual gold. See the link to Monetary Metals fixed income products in the video description and get started earning a competitive interest rate in addition to gold's natural price appreciation. Reason 3, understanding gold's strategic purpose. The distinction between speculation and strategic positioning might seem subtle, but these represent entirely different philosophies of investing. When you speculate on gold prices, you're essentially making a bet on short-term market movements driven by sentiment, technical factors, and timing. This approach needs you to be right twice when you buy and when you sell, and it positions gold as just another tradable instrument in your portfolio. Strategic gold ownership operates from a radically different premise. You're acknowledging certain structural realities about modern financial systems. Currencies lose purchasing power over time. Governments expand money supplies during crises. Geopolitical tensions create financial instability. Traditional assets like stocks and bonds sometimes move in synchronized declines. The theoretical foundation here draws from decades of academic research on portfolio construction and risk management. Modern portfolio theory emphasizes the importance of combining assets with low correlation to reduce overall volatility. Gold's historical behavior during market stress periods provides exactly this characteristic, but only if you own it before the crisis hits. Trying to buy gold after stocks have already crashed defeats the entire purpose. You've already suffered the equity losses, and you're now buying protection at elevated prices. Reason 4. Gold investing requires a deeper understanding of the economic landscape. Gold can best be characterized as wealth insurance. A long-held philosophy of gold ownership is, you don't own gold to get rich. You own gold to keep from going broke. On the contrary, I imagine investors who bought gold in 2023 in the $1,900 range have benefited greatly from the price appreciation. However, you simply do not wait until the cost of insurance is at record highs to finally insure that car or house. That would be irrational, correct? Well, the same goes for your wealth. The real question shouldn't be, will the gold price continue rising? The real questions are, will the dollar continue to lose value? Are we in an inflationary or stagflation currency environment? Is there continued economic uncertainty? Is there global conflict and geopolitical instability? Will the national debt and monetary expansion continue to grow? If you said yes to a majority of these questions, then the question of whether gold prices will continue to rise answers itself. How fast or slow depends on the momentum of the answers from those prior questions. Two more crucial questions that should settle the matter. First, from a long view of history, how many fiat currencies have lost significant value or have gone to zero? Feel free to Google that answer now. Secondly, how many times has gold gone to zero? You will not need to Google that answer. Finally, certain gold investing vehicles can provide tax-deferred growth. Gold IRAs are a tax-advantaged way of owning physical gold and silver without the need or liability of storing the actual precious metal in your own residence. These gold IRA companies provide lifetime customer support, competitive price matches, buyback guarantees, low fees, and secured storage. See the links in the video description to find the right gold IRA company that fit your individual needs. Fill out their short contact form and receive a free gold IRA guide. In the next part, we will expand on the top real reasons for investing in gold. Be sure to like and subscribe so you don't miss it. Thank you for watching.